What's up, everyone? I'm Dave Meyer, real estate investor and the Vice President of Data and Analytics here at BiggerPockets. This week, just like every week, I'm here to give you updates about the broad world of real estate investing and help you interpret what it all means to you. And this week, we have a lot of data showing us something that you've probably heard once or twice before already, but the housing market is going absolutely insane. And this is more than just a headline that you see in other places. The details here really matter to real estate investors. So let's get into the numbers and the fundamentals of the housing market right now so you can all understand what it means for you and your portfolio. In May, the median sales price in the US topped $350,000 for the very first time in history, which represents a 24% jump over last year and the 111th straight month of year-over-year gains, which is absolutely crazy. The housing market has just been on this long, consistent tear for almost 10 years. The 24% gain that we saw in May was the largest year-over-year gain that we've ever seen, at least since the National Association of Realtors started collecting this data back in 1999. And these price increases are also impacting the total volume of homes that are actually being sold. And we're seeing that because existing home sales have dropped for the fourth consecutive month. They actually dropped only about 1% from April to May, which doesn't sound like a lot, but we really, for investors, we want the market going in the other direction. And why this is happening is, one, because of the prices we just talked about. The housing market is just becoming less and less affordable for first-time home buyers, so people are just leaving the market. Secondly, as we've talked about a lot in the show over the last couple of weeks, inventory, the number of homes for sale, just remains really, really low. There aren't enough homes on the market for sale to keep prices lower and to get people buying more consistent. There is good news in the market and in the data that we've seen over the last few weeks, particularly on that inventory side. Inventory for existing homes actually went up about 7%. And this should help sales figures. It should help drive it back up and help temper price increases a little bit. But to be honest, it's going to take a lot more significant increases in inventory to change the dynamics of the current housing market. Now, what we've been talking about so far right now has been about existing home sales. But there's this whole other side of the housing market, which is new construction. And the data looks pretty much the same for new construction as well. In May, the price of newly built homes was up 18% from the previous year, so a little bit less than existing home sales, but still insane amounts of growth with 18% year-over-year growth. And just like with existing home sales, that means that we saw the total number of sales go down for new construction and actually dropped about 6%. This is the second straight month in a row that newly home sales volume has declined. But again, just like with the other half of the market, we are seeing inventory go up, but only about 5% with new construction. So what we're seeing in both existing home sales and new home sales is pretty similar. Soaring prices and decreasing sales volume. As I've said before, but I'm going to say again, to me this indicates that the housing market is not going to slow down in the coming months. As long as demand remains high and interest rates remain low, the market is very likely to continue on this path. But again, as I said earlier, there is good news here. Increased inventory does have the potential to return the housing market to a more healthy state. So seeing that inventory for both existing home sales and new construction is up in May, and to me, is pretty good news. For investors, I believe we're in for more of the same for at least the majority of 2021. And I know this is a crazy market and people are afraid of a bubble, which is very rational. But I encourage you all to think about the long term. It's hard to know exactly how the next few months will play out, but remember, despite rising prices and low inventory, the fundamentals of rental property investing haven't changed. If you can find a cash flowing deal, lock in a historically low interest rate, and keep a sufficient cash reserve on hand to weather any short-term cash flow problems or anything like that, rental property investing still offers really good returns as long as you are in it for the long run. However, if you're in it for the short run, that, to me at least, remains unclear. I've personally never flipped a house, but this wouldn't be the time I would recommend starting. And that sort of sentiment that I'm sharing about my own personal opinion is also reflected in recent data that came from Adam Data. They have released information that says that flipping housing activity has reached its lowest level in over 20 years, since the year 2000. And it seems that this wild housing market, the economic uncertainty, and all this crazy stuff that's going on have put flippers in sort of a holding pattern. They don't want to jump into new flips, and they're waiting to see what happens next. The data shows that now just 1 out of every 37 transactions on the market were a flip in the first quarter of 2021, and that represents a 5% decrease from Q4 2020 and a 7.5% decrease from the previous year. Profits for flippers are also falling, which is not great news. Adam has reported that the gross profit was down to $64K on a flip, which is down from $71K in Q4 of 2020, but margins remain high with the average profit at about 42%, which is great. I mean, who doesn't want a 42% profit margin? But of course, in this current market, that does come with a pretty good deal of risk. To me, all of the news that we're talking about today just underscores the need to keep your eyes on the long-term prize. When making investment decisions, think about where you think the housing market is going to be and where you want to be in the next 5 or 10 or 15 years. Don't think about as much of the short-term craziness as that's happening, as long as you are smart and conservative, and make sure to keep enough reserves on hand to weather any short-term problems. All right, team, that is it for me. Thank you so much for being here. I'm Dave Meyer, and if you did like this video, please make sure to give us a thumbs up and to subscribe to the BiggerPockets YouTube channel, or head on over to BiggerPockets.com where you can learn everything you want to know about real estate investing. Thanks again, everyone. I'll see you next week.